Podcast is now starting. All attendees are in listen-only mode.
Hello, everyone. My name is Ken Leon, Director of Equity Research with CFRA, and I'd like to welcome you to today's webinar on investment strategies for the Permian paradox. Joining me today are Stu Glickman, Energy Equity Analyst, and Beth Piscora, CFRA's Vice President of Editorial. Now, before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we will do our very best to answer as many of the questions as we can. Today's agenda. So we're going to be focusing on energy. For those who are not familiar with CFRA, I will give you an introduction about CFRA. Stu Glickman will run through the industry fundamentals, and then Beth Piscora will talk about the industry surveys to tie this all together. About CFRA. Slide 5 is our history. More than 90 years of growth as an independent research business. Today, we're one of the largest independent research firms globally. You can see the history where two entities have come together in October 2016, the S&P Fundamental Research from S&P Global Equity Research, and CFRA, which has a long history as well related to forensic, legal edge, and other capabilities from the risk metrics business. What's exciting about being at CFRA is our ability to provide integrated solutions. The flywheel of our efforts is really generated from taking data from data providers and the relationships we have, and an enormous database in terms of analytics and data, and leveraging that in a way that we can provide value add or our CFRA advantage. This comes from the 70-plus global analysts or professionals, the focus on regional and sector expertise, and our ability to provide deep analysis, deep dives, looking at data and trends that helps us in identifying dislocations or inflection points that drives performance, because everything we do ties to performance. And every week and every day, we are providing research and insights, thematic research, research on ETFs, on the broad coverage that we have. So another perspective on our proprietary methodology between fundamental equity and forensic accounting is putting that together holistically from top down, market commentary, sector and industry research, cross-asset for ETF and mutual funds. We cover over 1,800 plus ETFs, mutual funds. The first always to cover new ETFs on the street. And then our foundation of company research for both forensic and fundamental research. Our ability to provide quality, depth, and scale is really unmet by any competitor. And our portfolio risk monitoring. We provide on our platform, MarketScope Advisor, model portfolios, increasing interest from our customers. And we really take pride to showcase further our quality with differentiated idea generation, whether it be thematic or forensic accounting. Putting this all together is our credibility. Why CFRA? Because we're 100% independent. We also put our investment and our focus of our entire firm, all our teams, to research. And research is all we do. CFRA does not manage money or make trades. Many independent research providers claim to be free of conflicts, but they're not. So with that, let's get to the heart of our presentation today with Stu Glickman, first to talk about the crude oil macro picture. Good morning, Stu.
Good morning, Ken. Hi, everyone. I'm Stu Glickman. Thanks for joining us today. So I thought what I'd start off with is, for context, the crude oil macro picture, and then work our way down to a deep dive into the Permian Basin, why it's important and how you should think about it. Some further information on what we think the current energy bull case is in the Permian, and why there are some reasons to be a little bit more wary, which is our view that, you know, the Permian Basin is a nice basin to be in, but it's not the be all and end all, and there are other fundamentals that matter as well. So let's start on slide 10 here, oil macro picture. Right now the macro picture is in flux. Oil demand looks pretty stable to up. Incremental demand is largely coming from emerging markets, particularly in Asia. The oil supply picture, by contrast, is really unfolding with big market share swings. This is a really, I would argue, fairly recent development, particularly with regard to Iran. Renewed Iran sanctions are really a massive wild card. They caught the market by surprise because for the last 6 months, we have technically had sanctions, but we've also had waivers for those sanctions. So all the countries that really matter, Japan, South Korea, India, China, they have been able to continue buying crude oil from Iran with little implication. That looks like it's about to change. And so that's a wild card that I think is really affecting the supply picture going forward. Saudi Arabia is likely going to fill most of that gap, along with some of the U.S. community. Now, U.S. producers have been fairly disciplined so far in 2019. The big question is, will this last? The other wild cards that we have to think about on the supply side are Venezuela and Russia. Venezuela in particular has had a very difficult time watching its production edge lower and lower month by month. Lastly, you put this together, we think that oil prices should move higher near term. Spare capacity is getting pretty thin. The WTI outlook, you know, as of late March, we were looking for about $62 a barrel in 2019, $69 a barrel in 2020. That compares with about $63, $64 a barrel today. So, you know, perhaps kind of steady state for 2019, but moving up in 2020. Now a little further on crude oil demand. If you start with the blue bars, left-hand axis, this shows you that global crude oil demand was, call it 96 million barrels a day back in 2016, and it's been edging up nicely higher ever since. Should approach somewhere between 102 and 104 million barrels a day by 2021. Now the orange line, which is on the right-hand axis, shows you the change in that annual global crude oil demand, and it's pretty steady state. It peaked at roughly 1.6 million barrels a day net growth in 2017, and we're looking for somewhere between 1.2 million and 1.4 million barrels a day, 2019 through 2021.
So, Stu, when you look at the oil demand, Europe is slowing down. We hear about a slowing global economy. So from the perspective of geography, what should we be thinking?
It's an important question, and I think what you really ought to be looking for is emerging markets, and that actually segues very nicely into my next slide, on slide 12, which is a breakout of that oil demand, comparing emerging markets on the one hand in the blue bars against developed markets in the orange bars. Now I've put a vertical line slashing through this chart in the middle on purpose. What I want to do first is focus on the left-hand side of this chart. And what you can see is that in this sort of battle between who's more influential on oil demand, emerging markets are a leader, but really not by a massive amount, at least in 2016 through 2018. That picture changes pretty dramatically starting in 2019, where you can see that virtually all of the demand in 2020 is coming from emerging markets. And in fact, by 2021, developed markets are a hindrance to total global oil demand. So if you want to know, you know, what news flashes should we be looking at for what's happening with oil demand, really you want to be focusing on emerging markets in the next couple of years. So now let's take a look on the supply side. The U.S. has become fairly quickly a top 3 crude oil nation. Back in 2016, let's start with the blue line, which is on the right-hand axis. If you take crude oil, condensate, NGLs, all the different flavors of supply that come out of the U.S., that was around 12 million barrels a day, a little north of that in 2016. The expectation is that by 2021, this is going to reach closer to almost 19 million barrels a day in 2021. That's a pretty significant growth rate. Now let's look on the left-hand axis with the blue bars and the orange bars. Blue bars represent the change in U.S. supply year by year. The orange bars represent all of non-OPEC except the U.S. So this is folks like Norway, Australia, Canada, and so on. And you can see that at least starting in 2018, the incremental growth coming out of the U.S. really dominated overall supply growth from non-OPEC. That changes a little bit starting in 2019 and more so in 2020, but still the U.S. is leading the pack. And I think that's a really interesting change that's happened in the crude oil markets recently, and it just speaks to U.S. influence in crude oil supply markets. Now a little bit more on the OPEC side of the ledger. OPEC's influence is on the wane. What I'm introducing here is a term in the industry called the call on OPEC. And what this means is how much oil does OPEC have to supply to the markets in order to balance that market and make supply equal demand? As long as that bar is rising, it means that OPEC's influence is higher. It has more control over the oil markets. And what you can see is that OPEC's influence really peaked in 2017 with a call on OPEC of about 32.6 million barrels a day, about a third of total industry production. That call on OPEC is dropping and bottoms in 2020. That's an important factor that I think needs bearing, and it speaks to U.S. influence taking some of the reins.
So Stu, when you reconcile supply and demand for emerging markets, China's a big part of that. Mm-hmm. And we've got some significant political risk as it relates to Iran. Either A, they continue to be able to export, or B, what do you do next?
Yeah, so the countries that have been accustomed to buying from Iran has been exporting around 1.2 to 1.4 million barrels a day of crude oil, and China is the single biggest influence on that, about 600,000 barrels a day, so almost half of what Iran has been exporting. So China's in a little bit of a bind because on the one hand, they need the crude oil. On the other hand, they also have some fairly tenuous trade talks with the U.S. going on. And so how do you continue what you've been buying without scuttling the trade discussions? I think what's likely to happen is that China, at face value, says that it's going to be responding to the cuts by reducing the amount that they buy, but back channels continuing to buy at least a little bit. So I think it's something that bears very close watching. It's hard to get good data on China because China doesn't report precisely how much crude they've been buying. There are research providers that sort of indirectly try to assess that. That's something that we're going to keep a close eye on. To the degree that China does respond to these the new sanction demands and stops buying, it's going to put upward pressure on crude.
And those, what is back channel? What does that mean?
So China has a lot of what are called teapot refineries. These are small independent refineries. They're not buying through official channels through the Chinese government per se, but teapot refinery demand of Iranian crude is pretty significant. It's around 30% of total teapot demand. It's only about 6% for China as a whole. So the Chinese government, with official channels, official government agencies, and quasi-governmental companies like China Petroleum and Chemical or CNOOC, I think you're probably going to see less official buying from them, but perhaps with the teapots you're going to see a little bit more buying.
Got it.
So on slide 15 here, I want to talk about what filling the Iran gap by the Saudis would do to spare capacity. That dotted line that you're seeing on the chart, that reflects the maximum amount that Saudi is likely to be able to produce in a given month, at least in the near term, and that's around 12 million barrels a day. The blue bars show you the dark blue bars show you what they have been actually producing in recent months, usually in the neighborhood of about 10 million barrels a day, slightly less than that recently. But if you tack on an extra 1.4 million barrels a day from Iran, that's assuming full compliance by all parties, that brings you really close to that dotted line. And my concern is it may be that the Saudis can fill the gap for now, but what happens before the next supply shock? That is, I think, the biggest issue that the markets have to deal with or grapple with, is that the market likes having a little bit of a buffer zone of spare capacity above existing production. And if Saudi does fill this gap, it leaves that buffer dangerously thin, and it should raise the geopolitical risk premium that's built into crude prices. Now that we have that as context, supply demand, let's walk through a little bit more on the Permian Basin, a primer, and why this matters. So what you're looking at here on slide 17 is a picture of U.S. shale, the Key Basins. But before we go any further, it's probably worthwhile if I just take a second and explain what is meant by shale, because it's a term you hear a lot. For the folks who are unfamiliar with what this means, shale rock is essentially very brittle rock that's located in somewhat thin horizontal layers in various regions around the U.S. The Permian Basin in the brown is the one that we're going to be focusing on mostly today, but there are some other big shale plays within the U.S. for oil, particularly the Eagle Ford and the Bakken Shale, Eagle Ford in South Texas, Bakken Shale in North Dakota. Bakken, Permian, and Eagle Ford collectively are called the Big Three. The Niobrara region in the reddish color is a fourth, and then the Marcellus Shale over in the Pennsylvania area in green is really a natural gas play. But the Permian, by and large, is mostly an oil play, and that's the area that we're going to focus on here. So, a closer look. Chart on the left shows you that virtually all of the Permian Basin is in Texas, with a little bit of spillover into New Mexico. Permian as a whole, producing around 33% of total U.S. crude oil production today. That's about 4 million barrels a day on a base of about 12 million barrels. Now, the picture on the right is a map of the different Texas districts that make up the Texas piece of the Permian acreage. So if you want to drill an oil and gas well in Texas, you have to go through the state regulatory body, which is the Texas Railroad Commission. And the Texas Railroad Commission produces a fair bit of data on things like permits for drilling, what kind of well you're drilling, and so on. And we're going to take a closer look at District 7C, which is in the orange. Now, why does growth persist in the Permian Basin? The biggest single factor I can think of is really the top bullet, the well completion designs that are improved, and really what this boils down to is smart engineers. Some of the different tactics that the engineers have used across the industry, really, to improve production. One is more tactical use of frac stages. So you may have heard of a concept called fracking, where you basically flush a lot of water, chemical, sand in a big slurry mixture down into that shale rock and crack it open. And that is what used to be kind of a brute force exercise by the industry has become much more tactical, more surgical. They are using more proppant. That's that mixture that I just mentioned. More mixture that's flushed down the well keeps those fissures in the rock open longer, allows more crude oil and natural gas to flow out. And lastly, they're using longer laterals. And what I mean by this is a longer section of horizontal drilling under the ground. So what used to be maybe a mile under the ground has now grown to 1.5 miles, sometimes even 2 miles. So you're at more points of contact with this very horizontal section of brittle rock under the earth. The second important piece that's led to growth is targeted M&A in the Permian with more contiguous acreage. So there are 112 producers with Permian acreage these days. We've seen some recent combinations. Diamondback Energy purchased Energen in November of last year. Contra Resources purchased RSP Permian in July of last year. In both cases, the target companies were essentially almost all Permian acreage, and their acreage was contiguous with that of the buyers. So if you're planning on drilling a 2-mile lateral under the ground, you have to own the acreage in order to do that. Otherwise, you're going into somebody else's backyard. The last important piece that has really led to growth in the Permian is that oil services cost inflation has been really tame for several years now. There's always a bit of a tug of war between buyers and sellers, buyers of oil services and the sellers of them. And for the last several years, it's really been a buyer's market. So to the degree that cost inflation can remain low, that's a huge benefit for the E&Ps that allows them to drill and complete their wells more cheaply. So what this chart shows you is really just how astounding the productivity growth in the Permian has been in a really short period of time. Let's start with the blue bars. The blue bars on the left-hand axis show you the average amount of crude oil production per drilling permit. And I referenced earlier that if you want to drill in Texas, in the Permian, you have to have a permit from the Texas Railroad Commission. So this is a metric that I devised that shows you how productive they are per permit that's been submitted. And actually, the story is really not very encouraging between 1993, going in 5-year cohorts, down to 2008. If anything, the Permian was actually producing less crude per permit between 1993 and 2008, starting at around 23,000 barrels and change in 93. That had fallen to less than 10,000 barrels per permit by 2008. If you simply stop the chart there, you would have no rationale for expecting that the Permian was going to be any kind of important growth driver. And yet all of a sudden, beginning in 2008, things begin to change. By 2013, we're up to 24,000 barrels per permit. And then in 2018, it explodes. Now we're almost at 100,000 barrels per permit using data from 2018 in District 7C. The orange line, which is on the right-hand axis, shows you the share of all permits that are deemed horizontal drilling. So there are really two flavors of permits that you can, when you're drilling a well. You can either drill a well straight down, which is your conventional kind of well. That's the kind of wells that were drilled 70 years ago, even 20 years ago, in most places around the country. Horizontal drilling is a new breed. And that's where, because of the way the shale is laid out under the ground, you really have to drill horizontally in order to maintain better contact with where all that crude oil and natural gas is bottled up inside the rock. And so what had been less than 5% of all wells in 2008 has kind of really flipped, and now it's virtually all wells by 2018. It's that marriage between horizontal drilling and fracking that has led to this improvement, and I think it's really the guts of why the Permian has become so prolific. So slide 21 shows you in aggregate terms what's going on in the Permian. This is not just District 7C anymore, this is all districts. Permian crude in January of 2016 was producing around 2 million barrels a day of crude. By March of 2019, so a little more than 3 years later, that had grown to a little bit more than 4 million barrels a day. That is a production CAGR of about 25%. The March 2019 number is up 34% year over year. That's a slight deceleration because in March of 2018, the year over year production growth number was more like 39%. But anytime you can grow production north of 30%, that's a pretty steady clip. We see little reason to argue why production growth from the Permian should drop that considerably anytime soon. Now we'll look at, okay, well, why is production growth doing quite so well? This is a picture that shows you the battle between technology, represented by the blue bars, and geology, represented by the orange bars. And what I mean by this is the blue bars represent the improvement or the addition to production by new wells. The older wells, the legacy wells that were drilled last year, 2 years ago, every year those wells are going to produce a little bit less than they did the year before. That's simply the nature of geology. Once you've started drilling a well, the inherent pressure inside that well has dropped, and it's harder to produce the same amount of crude to the surface. And so it's natural expectation that those wells are going to decline. But what's interesting is the amplitude of the blue bars exceeds that of the orange bars, and that is represented by the black dotted line. That black dotted line, measured on the right-hand axis, has been above zero for virtually the entire period that we're looking at here. Every month, the amount of new production added in the Permian is exceeding the drop-off from older wells. As long as that continues, the Permian is going to continue generating higher aggregate production growth. So now that having gone through the Permian in a deep dive way, let's talk about, it's not just that you get the crude out of the ground, it's whether or not you can get it out of the ground in a cost-effective manner. And this, to me, is a really interesting chart on global upstream Capex, not just the Permian, but everywhere. And it shows you what the cost trends have been like over the last 10 years. Let's start with the left-hand side of this chart. The blue bars represent U.S. E&Ps. The blue line represents U.S. E&Ps. The orange line represents super majors and integrated oils, names like Exxon, Chevron, Shell, and so on. And what you can see is that between 2009 and 2014, if anything, these companies were all spending a lot more money per barrel of oil equivalent. What had been spending of $20 to $25 per BOE in 2009 had drifted up to close to $40 per BOE in 2014. So even though they were increasing production, they were spending higher and higher amounts of money to get that crude and natural gas out of the ground, which seems, it's kind of a head scratcher. Why would they be allowing this? Well, the reason is that crude prices for most of this period were in a $90 to $100 per barrel range. So they were really insulated from cost pressure because virtually any play was going to work. It was going to drive positive economics, but you get lax when the cost metrics don't matter that much. Now, fast forward, starting in 2014, look what happens to those cost lines. They drop pretty dramatically. This is out of necessity. What happened in 2014 is that Saudi Arabia started launching a market share war because they realized that the U.S. was simply taking share from them if they tried to protect price. They let price fall apart. They figured that the U.S. E&P community would disappear. And what actually ended up happening was this was a multi-year boot camp for U.S. E&Ps to get their cost acts together, and they did. And if you look at 2016 metrics, those costs were actually lower per barrel of oil equivalent than they had been in 2009. What we look at going forward, 2019 and 2020, we think that most of these companies are going to be able to continue maintaining relatively low cost metrics, even as they increase production, in part because the engineers have gotten very smart about improving productivity, in part because cost metrics or cost inflation remains tame.
Stu, it's an interesting chart, and the data is on the super majors or integrated oils. And when you look at this timeline, are the integrated oils late to the game for shale production? Mm-hmm. And is that drop in capital investment not doing as much new offshore, U.S. offshore drilling, or taking less risks somewhere else in the rest of the world?
That's a very good question. There definitely is a mix effect here because you're right. The Permian Basin and virtually all the basins in shale were not found by the integrated oils. This is something that the E&Ps discovered first. And what they found, if you look at what E&Ps were doing 2009, 2010, 2011, they were getting priced out of deep water. It was simply too expensive for a lot of these names to play in that sandbox. And so what they did is they said, we're going to see what happens with onshore shale plays, which are a lot more cost effective to drill. You get your time to first production is measured in weeks or months instead of years. And so when the U.S. E&Ps discovered that they were actually very good at getting the oil out of the ground, the integrated started to pay attention, and they have gradually started to shift their mix towards these shorter cycle plays in onshore U.S. So that is a driver in part of why these cost lines are going down, particularly for the integrated, but also I think it's just closer attention being paid to the cost line. So now that we've talked about the Permian Basin, why it's important, let's walk through what I would argue is kind of the energy bull case and why Permian exposure, arguably for the bull thesis, is important. So the bull thesis argues for higher prices, and I'm sympathetic to this argument because there's a lot of good reasons here that are listed. Number one is Venezuela. You have power blackouts routinely in the country that's accelerating production cuts. Venezuela looks like it's going to exit 2019 with 400,000 barrels a day of less production than how it exited 2018. Today it's down to around 700,000 barrels a day in absolute terms. That's a really unfortunate turn of events for Venezuela. And it puts simply more pressure on supply elsewhere to make up the gap. The second point is that the OPEC plus consortium, which really means OPEC nations plus Russia plus Mexico, have so far been putting up a united front. They have done a very good job at maintaining compliance with the production cuts that were advertised in January of this year. They're going to be meeting again in June, and the question is whether they're planning to continue. But Saudi cuts have been fairly strong. The third thing that augurs for higher oil prices, and I think this is probably the biggest right now, is Iran sanctions. A potential 1.4 million barrels a day could be excluded from the market. The Saudis can fill the gap if they want to, but that's really, as I mentioned earlier, it's going to take away a lot of spare capacity. And then lastly, you have outages beyond the U.S. and outside of OPEC. Norway and Australia come to mind. Not even mentioned here, you have sort of frequent flashpoints like with Libya or Nigeria. Those are nations that routinely come up with supply challenges. Those are the biggest issues why we should be optimistic about oil prices. Now, turning that into the Permian Basin, economics in the Permian are thriving. It has the best oil economics in the U.S. The internal rate of return, that's a standard industry measure for how good you are getting returns from the oil you're getting out of the ground. The median onshore IRR within the shale world is about 15% in the U.S. The two major subregions in the Permian are the Permian Midland and the Permian Delaware. Those look like they're going to be closer to 40%. And lastly, the oil cut from the Permian is above average. This means that when you're pulling those hydrocarbons out of the ground, you tend to get a little bit more oil, a little less natural gas. One of the features of this market is that oil economics tend to be a little better than gas economics. So if you can get more oil, that's a good place to be. A third point, and I think this is one that we're going to examine a little further, Permian pricing is expected to only improve against the key benchmark, WTI, or West Texas Intermediate. Alleviation of congestion. The Permian has been so prolific, it's led to congestion. So the argument is that, well, there's new pipelines that are coming into the Permian, and that's going to alleviate all the congestion, and so realized pricing out of the Permian should improve. I think over time, that's likely true, but there are question marks around that I think need to be evaluated. And then lastly, even at $50 WTI, the Permian IRR should still be attractive. The typical hurdle rate is at least a 10% IRR. Oil today is more like $63 or $64 a barrel. If they remain this high, Permian economics should be very strong. Now, the latest Permian wrinkle is mega mergers. This is sort of the last, I would say, leg of the stool for reasons why you should be optimistic about the Permian. Anadarko Petroleum is the shiny new object. Chevron has bid $65 a share for Anadarko back on April 12th. Occidental Petroleum counterbid with $76 per share on April 24th. That's a 19% hike. There's more news that has come out today, actually. Berkshire Hathaway announced that they are offering up to $10 billion in investment to support an Oxy bid. That investment is not there if Oxy doesn't win. So a lot of recent developments in this, and that has put a lot of upward pressure among some of the Permian pure plays. So the market is saying, well, if Anadarko is up for grabs, who else might be up for grabs? Since April 12th, Concho Resources is up about 16%. Pioneer was up about 12%. Diamondback Energy up about 11%. All three of those names are arguably pure play in the Permian.
So, Stu, when you look at M&A, and this is part of the bull case, part of your presentation, there's a premium, and the question becomes, would this continue for other large integrated oil companies interested in coming into the same space, or there's going to be some fundamental adjustment that maybe prices have moved too high?
Yeah, so I'm going to get into this a little bit more in coming slides, but I think Anadarko is a bit of a unique case in that I think it was perhaps more of a motivated seller than other names are likely to be. And so I'm not saying that it's not impossible for other names to be targets as well, given the interest in the Permian, but I think any of those names would have to receive a pretty rich premium just to even contemplate selling out, because their economics and their fundamentals are, in my view, considerably better than Anadarko found itself in.
And just pulling this together with oil prices, because you mentioned $63 a barrel, WTI prices coming closer to the benchmark. Is there a trigger point where there's appetite or less appetite for being in the Permian Basin through M&A?
Well, so it's a really interesting question. Near term, any of these companies would like to see oil prices higher. Right. But you don't want oil prices moving too high, because if they do, then what you end up doing is strangling demand. because people will go to the pump and they'll realize, oh my goodness, gas is now $3.50 a gallon, in some cases $4 a gallon. We've had that in the past. It's not right now, but we've had that in the past when oil hit $145 a barrel back in 2008. It ushered in a recession. And so E&Ps, at the margin, they like higher prices, but they don't want prices moving up that high. I think something in the $75 to $80 per barrel range would probably be their sweet spot. They high enough that they're making great returns, but not so high to kill demand. Now let's walk through some reasons to be skeptical of the Permian, at least wary, and not simply buy all Permian names on the basis of the top-down view. So I think it's really important to understand that Permian E&Ps, like all E&Ps, historically, chronically, used to generate massive free cash flow deficits. Every year, regardless of where oil prices were, they would end up generating about 90 cents to 95 cents of cash flow for every dollar they were spending. And the argument was, well, we're going to be growing, and so folks were focused more so on production growth and less on returns. It is based on what we're seeing for cost inflation, based on what we're seeing from the technological improvements that the engineers have been able to generate. It's pretty easy to expand drilling programs at relatively low cost. I'm worried that discipline is going to get eroded by high returns on Permian oil. And so what right now looks like maybe Permian oil growth going to maybe 5 million barrels a day sometime in 2020 versus 4 million barrels a day or 4.1 million barrels a day today, could go even higher than that and end up killing oil prices. The second issue that I think has to be examined for the Permian names is the question of pipeline access. The market is currently presuming that Permian discount to WTI is going to narrow, but pipeline development in this country is often delayed. Historically, that's always been the case. Lastly, and I think this is perhaps the least understood piece of the bear argument, is that natural gas from Permian oil wells has major pricing headwinds right now, to the point that at least a couple of weeks ago, Permian E&Ps were paying others to have the natural gas taken away. It's like having a yard sale and telling somebody, I'll give you a couple of bucks to take this fixture off my lawn. This is obviously not something that any company would like to deal with. It's effectively a loss leader. There are more natural gas pipelines that are coming into the region to help alleviate this problem. But again, that's an issue that I think it's a case that ultimately these pipelines are going to be developed. How quickly remains to be seen. My concern is that E&Ps are going to overproduce the Permian, and perhaps the realized prices coming from the Permian are going to be less than they would like. Now, a little bit further on mergers, since Anadarko and Chevron and Oxy has kind of turned into a telenovela in this space. Anadarko is a motivated seller. They have three facets to them that I think are unreplicated in some of the other names that we're talking about. The first is they have, at least in 2019, they have 100% unhedged Permian natural gas exposure. No other party that we've looked at in this space has the same issue. That's a problem when natural gas prices are a loss leader. The second issue they have is a low reserve life. What this concept means is pretend that you took 2018 production levels and just flatlined it going forward. How many years would it take to exhaust all of your production? Anadarko right now, or excuse me, at year-end 2018, had a reserve life of about 6.2 years. So in and of itself, it doesn't mean anything, but it's in the context of the average E&P with a reserve life of 12 years. Anadarko was looking at a reserve cliff, and it had to do something. Now, you can always grow your way off that reserve cliff by simply boosting reserves. But that leads to their third problem, which is they already had high debt levels. They already had, at year-end 2018, net debt to capital ratio of a little more than 62%, which is very high compared to the rest of the E&P community, which is on average around 35%. So it's not saying that Anadarko couldn't grow its way out and boost reserves, but where is it going to come up with capital to do it when their debt levels are already this high? By contrast, most Permian pure plays are relatively better off than Anadarko is. They have better use of gas hedging, they have longer reserve lives, they have better debt levels. Now, my conclusion is that Chevron will ultimately buy Anadarko only if they raise their bid. But Permian pure plays, I don't see a massive gold rush of more M&A unless other buyers are prepared to pay even bigger premiums to acquire them, because I don't think these other names are in the same kind of sell now motivation that Anadarko was in. Just a little further on reserve life. This is a chart that shows you year-end 2018 reserve life for a handful of the key names that we evaluate in the Permian. Anadarko is on the far left, a little over 6 years. The orange bar towards the middle right is the E&P average of around 12 years. For context, I include Exxon at the far right, around 17 years. Those dotted lines, the black dotted line and the red dotted line, show you one standard deviation above the mean and one standard deviation below the mean. So Anadarko really, just by definition, is an outlier with just 6 years. I think it's interesting that Chevron and Oxy are both kind of neck and neck, right around 11 plus years, both bidding for Anadarko and both trailing industry leader Exxon. Permian pure plays have better debt metrics than do Anadarko. If you look at the Anadarko dot, it's toward the top middle. This shows you that their reserve life of 6 years is complemented by a really high net debt to capital ratio. That is not true for the Permian pure plays here. Pioneer, Concho, and Parsley Energy, three names that are all more or less pure plays, or at least 90% Permian names. All of them much better reserve lives, much better debt metrics. They have the flexibility to stay organic, stay independent if they want to. I think it would take a significant offer to get any of those names to agree to be bought. Now, having gone through the bull case, the bear case, let's boil this down to energy investment views. How should you position yourself in energy these days? I think the important thing is to focus on the fundamentals, not necessarily on location. So we prefer E&Ps with a combination of decent production growth, but solid free cash flow and low debt, not just Permian exposure. ConocoPhillips, EOG Resources, we have strong buys or 5 stars on both. Devon Energy, we have a buy opinion or 4 stars. In all three of these cases, the Permian is an influence, but it is not the only game in town for each of them. ConocoPhillips probably has the lowest Permian exposure of the three, maybe around 10% or so. EOG Resources and Devon probably closer to about 30% Permian influence on total production. But again, they have other sources of production growth. They have other sources of free cash flow. And in all three cases, their free cash flow is really quite good, top quartile. Secondly, names to avoid. We would recommend avoiding names that have high debt, weak free cash flows, or higher future CapEx needs. The three names listed here, Apache, SM Energy, and QEP Resources, we have sell opinions or 2 stars on all three of them. QEP is a Permian pure play, kind of late to the game, late to join a fairly tired strategy that others had tried before them. Apache and SM, a little bit more diversified, but still having the same problems with debt and cash flow. The risks to our thesis, the biggest risk is that the Permian discipline remains strong, that the larger U.S. producers avoid overspending, generate high returns on limited production growth, protect those high prices, and that in turn would reward some of these weaker fundamental names that really do need higher prices to thrive. The second risk is that, in my opinion, is that merger momentum continues, that the super major oils make pretty compelling bids for Permian pure plays, maybe out of fear of missing out that everyone else is going to come to the dance before them, and that would end up perhaps rewarding location more than fundamentals would.
Thanks, Stu, for a great rundown, and I'm sure we're going to have lots of questions. But we do want to go to Beth Piscora to talk about using CFRA industry surveys to understand industry trends. Good morning, Beth.
Thanks, Ken. Really interesting, insightful presentation there from Stu. I was struck when Stu was speaking on slide 19, why growth persists in the Permian, and he attributed it to smart engineers. And I think of that and I apply it to our own company. Why does CFRA's growth persist? Well, it's because we have smart analysts. They are truly experts on the companies and the industries that they follow. It's great that you logged on to a webinar like this because it's a great way to get access. I want to talk about other ways that you can get access to inside our analysts' minds. You're probably very familiar with our stock reports and our research notes, but there's a lot more on MarketScope. And one of the things I want to talk about is the industry surveys product. So a lot of the content in today's presentation from Stu was originally in a industry survey, the oil, gas, and consumable fuels industry survey. All of our industry surveys are written by our analysts. They're updated twice per year. He was just talking about net debt to capital ratio on that scatter chart that he showed on slide 32. That's in the industry survey. All the surveys are going to have key industry drivers that are relevant to that particular industry. Stu would talk about things like liquid prices and volumes. All the industry surveys have a discussion of the existing operating environment, how the industry operates, and a real deep dive into how the analysts actually analyze a company in the industry. What are they looking at? What drives our STARS rankings? So I would highly recommend taking a look at the industry surveys if you have not already. One of the big discussions in this particular survey, which Stu's been talking about on today's webinar, is that oil assets generate better returns than gas assets. So if that's a topic that interests you, you might want to take another look at the survey. We have not just the oil and gas survey, but we do industry surveys on 44 different industries across all 11 sectors. You can see on this slide, it's a little small, but maybe go back and read it later. The executive summary from Stu's oil gas survey. All of them have our broad fundamental industry overviews, include any key ratios and performance metrics, and of course include a revenue and profit trend analysis. We've recently gone through a overhaul of our surveys, bringing in a new, easier to read design, use of a lot more charts and graphs. As you can see here are two sample pages from Stu's survey. Really in one page you get completely up to date on what has been the trend, and then the bullet points, those text bullet points are forecasts looking forward. At the start of this whole presentation, Ken talked about CFRA, where we sit as a company, and our access to data. I would say it's not just our access to data, but the way we curate it, the way we dig into that data to find the important metrics that tell the story, and then we share that analysis and that our interpretation of the data with you. That's what you're going to find in the industry surveys. So we've recently expanded our coverage of industry surveys. This is a list that was current as of February 2019, but we are going to be adding additional titles this year. And you can see it's across all 11 sectors of the economy. So I highly recommend, if you have not, to check out the industry surveys offering. There's new surveys being published every single week, and they're a really good opportunity to get that more in-depth thinking like was shared on today's webinar.
Are there any upcoming new survey topics?
Yep, there sure are. So we just this month, I think it's going to be on the site tomorrow, we are adding a new survey on the asset managers. And just last month, Stu, today's expert, Stu is also going to be writing in the future about the midstream oil and gas space as well. So I think we published the first one of those last month, and so that'll be on the regular update cycle. And in June, we plan to launch a new title on alternative energy, obviously a very fascinating subject. So keep an eye out for that one in June. Thanks, Ken.
Great. we're going to take as many questions as we have with time remaining. And to Beth's last comment about alternative energy, do we reach a point? You know, think about it. Several years ago, nuclear energy was prolific in Germany, Japan. It hardly exists today.
Mm-hmm.
So when we look at the phenomena in the shale production, could there be a dislocation?
So longer term, yes, I think alternative energy is going to make inroads into overall energy consumption. But if you look at the forecasts that folks like ExxonMobil and Chevron do when they look at what does the world look like in 20 years, 30 years, that's what they're planning for. They have the luxury of thinking long term, and they're putting most of their funding less into alternative energy, more into expansion of long-lived projects, deep water, liquefied natural gas, and of course some of the shorter cycle stuff in shale. I think that alternative energy becomes an increasing piece of the energy consumption mix, but I don't think it gets to the point where you get massive dislocation of the typical fossil fuel consumption like gasoline for cars, at least in a big way in the next 10, 15 years. I think it's longer than that.
Okay, so one of the questions came in was Venezuela, a lot closer to home than Iran, and whether today it's had an impact or it could have a future impact on supply and pricing.
It has already started to have an impact. This is a nation that used to produce over 3 million barrels a day of crude oil. That is, in the battle with names like Iran or Iraq, which are closer to about, at least Iraq's closer to about 4 million barrels a day today. But that 3 million barrels through mismanagement has drifted down and is now at around 700,000 barrels a day. Honestly, I think it's on its way to zero. And the kind of crude that Venezuela produces is a very heavy crude. It flows like molasses. It's needed by refineries who are set up to handle a marginal barrel that is heavier. And so it does affect the market because it creates a problem in sourcing from other heavy barrels from other places.
Here's a really interesting question. There's been a great deal of press regarding congestion issues in the Permian, and can you elaborate? And obviously, looking at supply and pricing, what is congestion? Will it continue? And we're talking oil, not natural gas.
Right.
And then, if it is relieved, what does it mean, from a financial standpoint?
So the congestion actually probably peaked sometime last year, and what this means is you have too many barrels of crude chasing too little capacity, pipeline capacity, to get it out of the marketplace. So if you're an E&P and you're producing barrels and you don't have pipeline space secured, what do? Well, you have a couple of other options. You can move the crude out by rail, but rail is more expensive than crude. Or you could or alternatively, you could move it out by truck, but truck is even more expensive than rail. So what it ends up doing is it pushes down realized pricing for Permian crude. If you didn't hedge what's called the basis risk, meaning I've got crude that's for sale in Midland, Texas, which is in the middle of the Permian, and I plan to ship it 500 miles to the U.S. Gulf Coast, what price am I going to get? That price had been pushed downward because of that congestion, the lack of capacity to move it cheaply out to the coast. So how the midstream industry, that's the folks that produce and manage and support the pipelines, what they responded with was increases in planned capacity of new crude oil pipelines that are going to join the market, but that isn't coming into the market until probably late this year, and perhaps even early next year. So the market is counting on that new pipeline capacity coming in and making it so that the discount that you get for Permian crude is maybe only $1 or $2 less than the WTI benchmark.
I'll call this the derivative call, and the question that came in was, are there collateral beneficiaries to the recent M&A interest in the Permian? So whether it be smaller, more niche players in E&P, or what I call the picks and shovels in terms of the pipelines midstream, how else can you play Permian?
Yeah, so I think first and foremost, it's put a floor underneath a lot of Permian E&Ps, the ones that might also in turn be takeover targets. I mentioned earlier that there's something like 112 different E&Ps operating in the Permian. That's a highly fragmented market. There's an argument to be made that you could consolidate that market, especially if you have two names that are with contiguous acreage. That's a positive because 1 + 1 is equal to 3 in that case. The other derivative call, the pipeline space, I see less positive influence from mergers because I think that most of the catalysts for pipelines are already in the marketplace at this point. They just have to get built.
So talk about liquid natural gas. It could we turn a challenge to an opportunity, whether it's LNG, exporting or ports to be built. Mm-hmm. At some point, could there be an inflection point that changes that part of the production?
So LNG has really started to blossom in the U.S. You have Cheniere Energy was the first name that started this in the U.S. Gulf Coast, but we started to see others. There's a facility in Cove Point, Maryland, which is now an exporting facility. Just for those who don't know, LNG, basically you cool the gas to such a low temperature it turns into a liquid. You can then move it across oceans and then sell it to the nation that doesn't have natural gas available to it locally. So Asia is a big buyer of LNG. When the U.S. started to build out their LNG facilities, the spread between gas available in Asia versus gas available in the U.S. was very high, and so it made that kind of deal almost a slam dunk. Those spreads have started to converge because more and more U.S. supply is making its way to Asia, and so I think LNG providers are going to make less money than they had in the past, but still enough to support a good value proposition. So I think you're still going to see more LNG expansion. ExxonMobil just recently went ahead and greenlit a deal to build out their Golden Pass LNG facility in the U.S. Gulf. If Exxon's is involved, then I think it's a clear signal that they think this has long-term legs to it.
So with the Permian opportunity, and we talked about Chevron and OxyPeat looking at Anadarko, we're in earnings season, and there was a big revenue miss for Exxon. Why was there a miss for Exxon? And is Exxon late to the game, or they're just going to come in big because they are big?
So Exxon was late to the Permian play, as was Chevron, but Exxon missed on its first quarter, and Chevron did not. Chevron beat, actually. Exxon missed mainly for reasons nothing to do with the Permian. Year over year, crude prices were lower. That was a problem that was affecting the whole industry. But Exxon also had, on its downstream segment, the refiners, they had a fairly heavy maintenance schedule, and the convergence of prices in Canada was a real headwind for them with refining margins. That was what really caught the market by surprise, I think. We liked Chevron's quarter, and we actually upgraded Chevron after the call to a buy from the hold.
Okay. Stocks, as you know, are discounting, forward outlooks, and one of the issues looking out 3 to 5 years is a shift to electric vehicles. Mm-hmm. They don't need oil anymore, and the question is, with efficiencies there, what impact it could have on the demand side, or this is just another fancy trend that's just not going to have substance.
Electric vehicles, I think, have legs to grow further. The biggest problem I think that's affecting electric vehicles is a kind of an infrastructure coordination problem. It's one thing if you're only driving 20 miles, 25 miles from home and you can count on a station that can charge up your car, but what if you're planning on driving 500 miles and you're not sure where exactly you're going to be able to, quote unquote, fill up? I think there has to be better coordination from government as well as private industry to make that kind of infrastructure broader, and then I think you're going to get better take-up.
So I have one more for you, Stu, then one for Beth, and this one gets to kind of the macroeconomic picture and inflation. So if we have oil prices go up, even let's say to 75 or in that range, and it triggers cost plus inflation, what effect do you think it would have on the demand side and then have an effect on oil prices?
Yeah, certainly it's a risk. If oil prices go up to too elevated a level for too long, then it does raise the risk that that participant raised. However, I would say that, you know, the industry in prior years has stomached $75 oil, and it hasn't triggered inflation. So I think you would need above $80 oil. I've seen some cases where people are saying more than $100 oil. I think on a conservative level, north of 80, I start to question whether or not we're killing demand through that very argument.
Thanks. And Beth, the whole team you're leading has done a great job with CFRA industry surveys. If I'm a Market Scope Advisor customer, how can I access that on the platform?
Sure. So right on the home page, if you go over to the left navigation, there should be a tab for either sectors or industry surveys. You can find the industry surveys on either of those tabs. Or say you're interested in ExxonMobil. Stu was just mentioning Exxon. Again, right on the landing page, right there at the top of the page, you'll see a link to download the stock report. You'll also, right next to that, see a link to download the relevant industry survey. So there's all sorts of ways, and if you have difficulty finding them, just call into our client relations department. They'll be happy to talk you through it.
Great. So before we adjourn today's session, I'd like to invite you to register for our next webinar planned for May 14th, where my colleague Todd Rosenbluth, head of ETF and mutual fund research, will be joined by Dodd Kixley, National Director of Davis Advisors, and the discussion topic will be Understanding Actively Managed ETFs. Links to register for this session will be sent to you later today, along with the recording and slide for today's session. I want to thank both Stu and Beth, and on behalf of the team at CFRA, we'd like to thank you for joining us today. For those of you who subscribe to our Market Scope Advisor platform, therein you'll be able to find many of the research notes and analysis that we covered today, the industry surveys, and much more. If you're interested in learning more about Market Scope Advisor, please visit our website, www.cfraresearch.com, to request a trial. Should you have any questions further, please don't hesitate to contact us at cservices, again, that's cservices@cfraresearch.com. Again, thank you for joining us and have a great day.